Last week, I made 5,000 US dollars using the concepts I'll show you today. Now, I'm telling you that because although I might be the worst cook in human existence, I'm quite confident in my trading abilities. Confident enough to give you advice on this topic. So without further ado, diving straight into it. Here we are on Euro US dollar on the 4-hour chart. We need to go over 3 steps in order to understand this concept. Where the first step is ranges. There's 2 types of ranges. There's an ITR and an STR. ITR stands for intermediate term range. STR stands for short term range. Where if we start off with a short term range, the short term range is very simply said from a swing high to a swing low, like this one right there, or the opposite from a swing low to a swing high like this one. That is a short-term range. Now, an intermediate-term range is a little bit different. It's the bigger brother of a short-term range. And what I mean by that is this, for example, right here is an intermediate-term range. Why? Because the high that we have sitting right there and the low that we have are both intermediate. This is an intermediate-term high and this is an intermediate-term low. Because this intermediate-term high has a short-term high lower to the left of it and lower to the right of it, making it an intermediate term high. And this intermediate term low right there has a short term low higher to the left of it and higher to the right of it, making it an intermediate term low. So the short term ranges are the smaller, most recent ranges, and the intermediate term ranges are the bigger ranges. All right, now that we understand that, for example, this is a range, that is the most important thing, that you understand that right there is a range. The swing high that we have sitting above the range right there, and the swing low that we have at the bottom of the range, that is what we call external liquidity. So the swing high and the swing low is that external liquidity right there. So price moving above or below a range is external liquidity, is taking external liquidity. Now, this move above right there, above that high, is taking external liquidity. So what then is internal liquidity? Well, if we are making a retracement right here, for example, into this range, when we are making a retracement, we are moving internal and we are taking internal liquidity in the form of, we have a retracement into the range, which makes it internal liquidity. After we take internal liquidity being fair value gaps, for example, right there, to continue higher off of that, then after we take again the external range high right there, taking external range liquidity. So as a rule of thumb, and you might know this one, price moves from external liquidity right there to internal liquidity right there, formed of fair value gap, could also be an order block, to then again move to external liquidity. So based on that logic, a lot of traders would see this and would expect something in the form of this. Higher prices off of this right there. But we actually see the opposite right here, because we see lower prices targeting again external range liquidity right there. And this is where we need to understand a sweep versus a run on liquidity. And when we understand that, I can guarantee you that you will be better than a lot of traders out there, because you will know exactly where price wants to go. So let's start off with defining a sweep. A sweep of liquidity is when we take external liquidity, for example, in the form of this swing high right there, because that is again external liquidity, and we immediately reject below that high, creating a bearish fair value gap right there. That creates a sweep of liquidity. The same what we saw actually right here, when we took that swing low to the left right there, this is also a sweep of liquidity. Again, seeing through. We take external liquidity, we immediately reject below external liquidity or reject above external liquidity right there, creating a fair value gap. That is a sweep. Where a run on liquidity is the complete opposite. Now, when we are sweeping liquidity right there, what we can target eventually is the opposing liquidity in the form of the other external liquidity right there. So then it becomes external to external right there after a sweep of liquidity. Where a run on liquidity is the complete opposite, because a run on liquidity is where we expect price after taking external lows, external highs, external liquidity to keep on running. So for example, if this was a run on liquidity right here, then we would expect price to now continue higher to target the highs right there, to target the next draw on liquidity. Where after we have a sweep, of course, we see the exact opposite and we expect external liquidity again in the form of those lows to be taken. So if we dive a little bit deeper here into the 1 hour time frame, and on the 1 hour time frame, we can clearly see again this sweep of the external liquidity to then continue lower. And we create this new range right here. Can you see this new range? And can you see the difference between this range and the bigger range that we saw on the 4 hour right here? Because this range is having a difficult time staying above that external liquidity. Where on the 1 hour right here, this range is having a very easy going time to stay below this external range liquidity in the form of that swing low right there. That is exactly the difference between a sweep and a run on liquidity. This is where we can now expect that this range right there will hold to continue lower. So this in fact is true, where we move from external to now internal right there to then again external. So eventually, if we continue lower and we continue lower, we create this new short-term range. Again, it looks all right. We do not have a convincing close below that low, right? If we compare to this low right here, this was a convincing close below that low. Whilst this one, not really, because that third candle right there, again, is a big move higher. Now here, you can expect the same. This range right there to hold, because we move from external to internal to then again external. But what happens? Well, we do not do that and we continue higher actually. So what happens here? Do we look at this as external right there as well to then here internal to then continue higher and to then ignore the sweep that we had right there and still continue higher? No. Why not? Because the 1 hour range that we had sitting right here is not in context of the 4 hour, meaning this range will not hold if there is a 4 hour fair value gap above this range. And what do we see on the 4 hour? We see that we have a 4 hour fair value gap right there above that exact 1 hour range high right there. And the 4 hour, as we know it, is of course the stronger time frame because it's above the 1 hour time frame. So right here, this is exactly what we can continue lower from right there. This is where we now move to internal because we have an internal retracement into the range right there. After that internal retracement, we expect the external move towards that low again right there. And when we have that move to that external low, what do we see right here? We see a confident close below the external liquidity, that swing low sitting right there, indicating to us again that we are running that liquidity. And when we run that liquidity, we are seeking for a next discount array in this case. We are seeking for a lower draw on liquidity, which in this case is this swing low right there, which we had already determined after that sweep happened. So how do we actually capitalize on this? Well, here we moved from external again, right here, to what do we see? 4 hour value gap right there. That is the internal move of this range right there to then target again the external, which in this case is this low sitting right there, and eventually the low that we had to the left as well. And in that 4 hour value gap, that's where we can now find our entry pattern. And when we are on the 50-minute, what do we actually want to see right here? We want to see sweeps of highs, of swing highs, and we want to see runs below lows, below swing lows. Because again, when we are sweeping something, that indicates that we are going the opposite direction actually. When we are running liquidity, that means that we are going still in that exact same direction. So what does that look like here on the 15-minute? On the 15-minute, we now have this swing high sitting right there. And once we come above that swing high, eventually right there, and we trade into the 4 hour fair value gap, then here the ideal scenario is that we sweep those highs. Because when we sweep swing highs, after the sweep we will target swing lows, opposing liquidity. So right here, once we sweep those swing highs, actually eventually we create a bearish fair value gap right there. And we can also see that we are now closing below swing lows right there very confidently, meaning we are sweeping highs and we are running swing lows. A sweep of highs and a run on lows is the clearest indicator that you will get on bearish price action. For bullish price action, the clearest indicator is again a sweep of lows and a run on highs. Where right here, eventually we continue lower, and what do we see? Every time we come below swing lows, we run them. We do not sweep them, we run the liquidity. So at that moment in time, this was my actual entry right there. I covered the highs sitting right there, targeting the lows because I still understand the 4-hour picture that we had right here. Continuing lower of that 4-hour internal liquidity towards the external liquidity right there. And on the 15-minute, I did the exact same thing. And eventually on the 15-minute, what do we see? We see that we continue lower, and we hit our take profit quite fast. After we reach these lows, we have now reached external liquidity. So what can we see? When we reach that external liquidity, we again could expect, all right, external, internal right here to continue lower off of that. But there's a very interesting thing that we actually see right here. We see a huge aggressive move going higher again right here. So this is known as a sharp turn. A sharp turn is right here when we have a bearish fair value gap coming into external liquidity and then a bullish fair value gap coming into internal liquidity again, coming back above the external liquidity low right there. This creates an overall sharp turn. That sharp turn is what you can use as an entry in itself after sweeping external liquidity to then target the opposing external liquidity right there. Because again, when we take external liquidity, if it's a sweep, we are targeting the opposing external liquidity. If it's a run on the external liquidity, we are going to see internal to then again new external to continue in the same direction. Where here, once we see the sweep right here, we eventually get this new range. That new range is now your what? It's your internal, the retracement, to then continue higher off that to target external right there. So now after we close above this external high right there and we run the liquidity, what do we see? We will target a higher premium rate. What is higher after this 4-hour value gap? Well, there is this order block on the 4-hour sitting right there. So if we dive back into the 15-minute with that 4-hour order block that we see right here as a target, then we can delete the fair value gap that we had, and all ranges that we see right here is where we will expect only internal moves right now to continue higher towards the next draw on liquidity in the form of that 4-hour order block right there, where eventually we deliver right there. And we saw a small right here internal move to then the external move, continuing higher, where afterwards the same thing happens again. We reach the 4-hour order block right there. And when we reach that 4-hour order block, if we want to continue higher, we should close and run those external liquidity highs right there. So again, to define that in a bullish trend, we are running highs and we are sweeping lows right there. That is the most important part to understand. Then in a bearish trend, we are doing the exact opposite. When we then switch from a bullish trend to a bearish trend, we will sweep highs to then run lows right there. It's the best indicator again that you can get to determine your direction. So right here, what do we see? We see a sweep of the highs, but also a sweep of the lows. In that instance, you want to simply wait. Wait until we close further above the high or further above the lows. And right here, we see we are slowly starting to close below lows right there, indicating that we might actually want to continue lower. Because if we want to continue lower, we should again sweep highs and run lows, where eventually we continue lower, following external to internal, right here, right here, right here. And then we see it over and over. External to what? Internal, right there. And also external, because we are sweeping highs, right there. Internal to continue lower. External, right there. External, internal, external again. And afterwards, what do we see? Internal, right here. And then after internal comes external, right there. And since we are running lows, we will continue lower eventually until we do what? Until we now start to have weird behavior where we start to sweep lows and start to run highs. That is exactly when the external internal stays the same, but our bias changes. And that is very important to understand, because right here, what do we see? We run highs in the form of those swing highs, and at the bottom, what do we see? We sweep lows right there to eventually continue higher off of that. Now, if you found this valuable, then feel free, of course, to share it with your trading buddy. And then we as a team can outperform all the other traders in the money-making team. All right, perfect. Thank you.